Okay, I think we're good. It's like admittedly stupid, but um yeah, I think we're fire. So we're locked. We can kind of just do one of these. Well, I'd like to switch it actually. Um, yeah. Okay, wait. I gotta send. I gotta send the link to. I gotta send a link to my sisters. I do need different thumbnails for my. Okay, wait. I'm gonna keep my phone up just because that's funny. Yo. Okay, okay. Wait, are we even playing? All right, there we go. All right, fire. Just so I can see if any of my people respond. Okay, I think this is really funny. So, all right, we're hopping into our chapter two notes. Also, I've got an hour and 40 on the clock. Maybe I should add a timer. How the heck do you add a timer? I think that would actually be clutch. And I think it'd be. Wait, what the heck is 25x? I don't even know what the XP even means. Okay, wait, hang on. First, how to add a timer to OBS stream. Use the built-in countdown.lua script. Create a text here. Go to Tools, Scripts, load the script, set your duration, and assign it to the text source. Huh? Okay, wait, let's try and figure that out first before we even do that. Okay, so let's add a text. Add text. Okay, 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 okay. Create new. All right. Then what? Using the built-in countdown.lua script. Countdown.lua script. What the heck does that even mean? Countdown.lua script. I don't really know what it's talking about. Background opacity, text transform, ner, all that. Select font. Is there a countdown font? Is that what we're talking about here? Countdown. No. Um, that's great. Okay, okay. Create text source. In your scene, go to the sources. Select text. Name it timer. Ooh. Okay. Hang on now. I can do that. Name it timer. Rename timer. I'm on that. I'm locked. I'm locked. I'm locked. Open scripts. In the top menu, click tools. Tools. Okay, scripts. Hold on now. Add count. Add countdown. What? Scripts. I'm so confused. What if I just click this and then click output timer? Stop streaming. What are Yo, I don't even know what's going on. Stop streaming. No, no, no. That's the wrong kind of timer. Click the plus button at the bottom left. Select countdown to IOA from the default OBS scripts folder. Oh, tools, scripts, plus. Oh my goodness, countdown.lua. Guys, that's actually crazy. Okay, okay, okay. And click duration. Hold on now. I don't want a duration. I want like. I hope it can like sets a text source to access the countdown timer when the source is active. Command line duration. I don't want the duration to be like that. On the right side, set the duration in seconds. On the right side, set the duration in seconds. How do I even do that? Under text source, select the text source you created in step 1, so the final time. This is very interesting. Edit script. Oh my days. That is scary. Timer. Wait, I don't want a timer. I want a stopwatch. Let's remove this. Remove. Back to tools. Back to scripts. Where am I? Here we are. Add a plus. Clock source? Could it be clock source? How to add a stopwatch? That's what we're looking for. Count up timer? Oh, brother. Using the built-in countdown. Have a stopwatch. Go to tools. Plus button. Script. Click here. Select the text source. Create a new. Go to script. Y'all. What the heck does that even mean? Adds a clock source which draws an animated analog clock. I do not want an analog clock on my stream. I do want... Holy days! No. I do want... Countdown anyway. Okay. I don't want it to be... What if we do... We could just... Okay, let's just do 60 minutes. That gets us to... Yeah, okay, 60 minutes is perfect. It's perfect. Alright. That's good. Final text. Done studying. Close. Now, I don't even know, man. Configure in the text as well, bruh, how do I actually do the freaking timer? You know what I mean? Add source. What if we hop in here? No, that's just not at all. Not at all what I'm looking for. How do I add the countdown to the text? On the right side, set the duration. Yep. Under text source, select the text source you created from someone. What? Oh my days. So I was in here at one point. Y'all, this is trippy. This makes no sense, to be honest with you. Scripts, writes. Where's the whole text source? Oh my word, bro. I'm goated. Okay, we're good. We're dialed. We're dialed. That's gas. That's actually so tough. Okay. So then I can set... Tell me I can't. Because I can't. Alright, that's chill. I didn't need that. That's fine. Okay. Guys, we're doing great. I just added a countdown timer. Okay, but that means we gotta go. Oh. Okay. We're back. We're back in business. Now we actually have to do real work. Admittedly, that text is a little corny, a little goofy. but that's fine. I'm gonna open my window because I'm kind of hot. Having those lights right on me. All right, fire. So we're moving to chapter 2, analytical approaches used by financial planners. An introduction. So we're going through the analytical approaches, the computations, a lot of calculations will be in here. Financial planning involves mathematical calculations, makes perfect sense. Sophisticated calculators and software programs are available. We got ours right here. Made multiple ways to derive the correct solution to a financial planning question. For example, one financial planner may choose to adjust a future value calculation for taxes at the end of the period. At the same time, another may wish to adjust the savings needed. Okay, both financial planners should derive the same or similar answer. This can sometimes confuse those new to the logic of time value of money computations. Okay, financial planners should choose the method they're comfortable with and practice that method until the process becomes second nature. Makes sense. Also important to ensure accuracy in both the input of the data. Okay. Briefly review some of the most critical calculations. Okay. Purpose of the chapter. Review the most critical calculations made during the financial planning process. That's very helpful. It kind of frames our outlook on this study session. So that's what we're going to be doing. Fire. Keep in mind, each of the strategy techniques and approaches presented in the chapter represent minimal competencies for a financial planning professional. Other calculation techniques will be presented throughout this book. Okay, so it's not fully comprehensive. More calculations to come. Very cool. Glossary terms. Okay, investment rates of return. Okay, so 2.3. Let's go chapter by chapter. We're not going to worry about how long the chapter is because it is quite long. I'm just going to go. Hang on, I'm doing this on my. I'm texting my sisters. We're the only people who are going to watch this. Brian Sodi account. Okay, fire. We're back. Okay, sick. So, investment rates of return. So all of this should be familiar. We're trying to kind of be getting the rust off because, wait, there's two people here. Okay, fire. Okay, that's sick. Investment rates of return. If you are one of those other people, send a message. You don't have to. It doesn't matter. Okay. I'm literally just studying my financial planning book. That's all we're going through. We're going through chapter 2, computations for financial planning. One of those people is myself. Sorry, I have my own stream open. Because this is fun. This is fun for me. I'm having a good time. Calculating a rate of return. I don't know what the, if it's chill. Oh, and they're gone. That's fire. One of the most elementary of all personal finance calculation involves determining the total return earned on an investment. Naturally, financial planners use this calculation to determine how much profit has been earned on an investment during a specific period. Rate of return describes the relationship between profit or loss relative to the amount saved or invested. Naturally, okay. For example, assume an investor deposits $1,000 into an account. The account has a stated rate of return of 6%. Okay, an investor deposits $1,000 into an account. Investor deposits $1,000. The account has a stated rate of return of 6%. Rate of return, 6%. And the investor leaves the deposit in the account for 1 year. Leaves deposit in the account for 1 year. What will the account balance be at the end of the investment period? What will the account balance be at the end of the period? So this is kind of our example problem here. And so this is our out of the y. This is our so this is like throwing me back here to time value of money stuff, which is kind of, I don't know what I'm saying. So this is our n. N, when you're doing time value of, oh frick, what the heck? Okay, n is your time when you're doing a TVM problem. Rate of return, that's going to be your I to the y. And this is your okay. Boom, boom, boom. Make sure you're clearing your calculators when you're doing these problems. This is your PV. And so what will the account balance be at the end of the period? You're solving for, since you're with the account, you're solving for the future value, which we all know. So this gives you three variables with this one x essentially. And so your PMT is going to be 0 because that's not the kind of problem we're doing. You're going to want to make sure your calculator is in end mode, I begin, not beginning mode, because you're depositing it at the start. Okay, so make sure you clear it. Let's see what the actual problem does. I don't know where this is going to lead to or what any of that means, but fire. So, okay, so we have our PV, we have our out of the y, we have our n, and we're just solving for PV. So this is kind of just review, but you're going to put your $1,000 into your calculator for PV. Then you're going to put your 6%. You're just going to put 6 on my calculator. I have an HP 17B2 Plus. You're just going to put the number 6 for the percent, and it'll automatically do the percent. You're only leaving it for 1 year, so 1 is your n, and then you don't have to put 0 for PMT, it's kind of implied, but then you do your future value. And so this doesn't look right. Let me make sure I did this correctly and I put it in correctly. So we have $1,000 PV out of the y, 6 for 1 year, and you're solving for future value. And so you're gonna get, your future value is just 1,005. Well, it comes out as a negative, but obviously, if you're using your critical thinking, if you're leaving it in the account for a year, and you have a rate of return of 6%, how the heck is this 1,005? I think I'm doing this wrong. I literally don't think I remember how to do this problem. Because 6% of 1,000, 1,000 times 1.06 times 1.06 it should be 1060, but this book doesn't have a like an answer key for this. Let's just keep reading here because I legit don't think that's right. It just doesn't make any sense. Maybe it's because, should there be perhaps 12 periods in a year or 1 period in a year? Out of the way, rate of return is 6%. Is that per month or per year? Let's try and switch it to periods per year. Oh my days. Let's try that, and let's exit. Let's try this again. So let's now go $1,000 for present value, 1 for n, 6 for our percent, 0 for our payment. Future value is boom. Okay, that was our issue. Because obviously this should be 10,060. And again, it does come out as a negative when you use your brain. Obviously, that's just how it works. So that's beautiful. Okay. So that's that first half. That's that first little part of this. What will the account balance be at the end of the investment period? How much of the account balance is principal and how much is interest? So our interest here, when you break it down, interest, well, principal is that 1,000 we put in. Interest is $60. So that's beautiful. That's a great thing. And again, this is very rusty. This is review for me, but it's been so long since I've done this that it's very important for me to be doing this. How the heck? Get me out of it. Get me out of this formatting, bro. Okay, regardless, we're chilling. All right, cool. Principal, how much is interest? We got it. How much will the account be worth if inflation, the general increase in the price of goods and services over time, averages 4% over the same period? How much money will be available after paying taxes on the earnings? All of these questions are answered by using various rate of return calculations. Okay, so all that is just saying, hey, here's some examples. This is what we're going to be talking about later. To calculate that rate of return on investment, all sources of income must be identified. Okay, the two most common sources of return are income and capital gains. Income is like earned from your job. Capital gains is like money you make on investments. Income is generally derived from periodic payments an investor receives in cash or as deposits to an account during the investment period. Examples: stock dividends, bond interest payments, mutual fund dividends, and savings account interest payments. That's all income. Okay, I think that's actually going to be important for me to differentiate because I didn't really know that. Okay, fire. So we have income, and then we have capital gains. So since I don't know the difference, income is so payments an investor receives in cash. Payments an investor receives in cash. Hold on. If I add the Pride and Prejudice soundtrack to this stream, would you guys be able to hear that? Instead, let me go to YouTube. What the frick? Let me go to copyright-free study music. Let me cook, bro. Copyright-free dark academia study music. Sure. I like the sound of that. Okay, we're cooking. Can y'all even hear that? Hang on, let me see. Hang on, I gotta wait for it to catch up on my stream. Come on. Is this working? Bro, it is. That's cool. Let's go. Okay, fire. That's tough, bro. Alright. I like it. It's a little too loud. So let's do that. Okay, fire. Okay, so we're back. It's still too loud. Okay. So we have income. Payments an investor receives in cash. We also have okay, wait, turn it off. Receives in cash, or as deposits to an account during the investment period. So examples: stock dividends, bond interest payments, mutual fund dividends, and savings account interest payments. Savings account interest payments. Capital gains, on the other hand, received or realized when an investment period ends. Realized when an investment period ends. When an investment period ends and the investment is sold liquidated, and or matures. Cool. If the security is sold for more or less than the purchase price, the investor will realize capital gain. Makes perfect sense. When security is sold for more or less than the purchase price, the investor will realize a capital gain. Makes a lot of sense. Perfect. Perfect. This is all review. This is all review. Let's just make sure we have our terms defined, and then we'll get cooking here. These two sources of cash inflow serve as the basis for the nominal return on investment. A nominal value in its simplest form means an unadjusted value. Nominal value, term, nominal value means unadjusted value. I didn't quite know that. A nominal value is the gross return. AKA gross return. Cool. The most common adjustment to a nominal value is the inflation adjustment. Most common adjustment to the nominal value is inflation adjustment. Cool. Adjustment. However, nominal values can also be adjusted for other reasons. Inflation, taxes, compounding frequencies, other factors. Cool. When calculating total returns or future values, it's essential to understand the interrelationship between the nominal and adjusted rate as it is calculated to the nominal rate. Essential to understand the interrelationship between the nominal and adjusted rate as it is to calculate the nominal rate of return accurately. This makes sense. Okay. Holding period return. Moving into a new category. Holding period return. Return. Okay. A simple method for calculating nominal returns involves determining an investor's holding period return. Also, HPR, holding period return. Kind of a new term to me, so I'm not sure. The formula considers the investment's beginning and ending value, present value and future value, income earned during the holding period, and transaction costs. The income received could be dividends from an equity or stock investment, or the income could be coupon interest payments from a debt or bond investment. The formula is as follows. Okay, HPR equals, on top we have income plus ending value minus, let's just put end value minus beginning value minus transaction cost. That's on top, over the beginning value. Very, very interesting. Example. Bob purchased one share of stock for $45 per share, received 2 dividend payments of $1 each. What the freak? Hold up. What is this little symbol? The sum, income. What does this symbol mean again? I forget. Sum of, two dividend payments of $1 each. So, for our income, we're doing the sum of the dividends. Makes sense. He purchased one share for $45. Okay. That were not reinvested and paid a transaction fee of $5. Bob then sold the stock for $55. What was Bob's holding period return? Okay, so given that, he had 2 dividend payments of $1, and then he had another $1, plus the end value, where he sold his stock for $55, and he bought the stock for $45, and he did not reinvest them. The transaction cost, he paid a fee of $5. You see what's happening here? and then you divide all of this by the beginning value, which was $45. And so what you're left with is 2, well, you get, let's see, 10, 2 plus 10, 12 minus 5, 7 divided by 45, right? Reading 7 divided by 45, which I'm just going to look at the book, 15.6%. That's your HPR. A common modification to a nominal rate of return is an adjustment for taxes paid at the state and federal level. Calculating tax-adjusted returns can be complex. What type of income? What tax rates? Sure. Interest income, dividends. The rates also may vary depending on the holy period. Okay, sure. To accurately calculate the tax-adjusted rate of return, the HPR must be offset. This is way too dramatic. Let's instead go lo-fi. Wait, let's go copyright free Bad Bunny beat. That's not at all what I meant to say. Lo-fi music. Sure. Let's actually go house. House could be lit. 5 hours deep house, lounge, beach, bar, club, chill. That's too much. Too much going on there. Let's just hop in this playlist and see what happens. I'm sure autoplay is cooking. Okay. I mean, this is very like corporate core, but we're chilling. Actually, I hate it. Minecraft music. Minecraft, all YouTubers background, no copyright. That's what we like to see. Okay. And we're back. To accurately calculate the tax-adjusted HPR. So we have HPR. Now we're looking for tax. Okay, can you move out of the way? Tax-adjusted HPR. Okay. The HPR must be offset by any tax liability generated as a result of owning the investment. The following adjustment can be used for historical return calculations. So, you have income minus income tax. I'm just trying to convince myself this is important. I can't lie to you. Plus cap gains minus cap gains tax. Sure. Minus cost adjusted for tax. What the frick? What does that even mean? Okay. We're just running with it, y'all. Beginning value. Sure. That makes sense actually, because that's what I was actually wondering, where the beginning value would be, because this looks nothing like this. Let's see. Actually, how is it different? So we had income, and then we had end value minus beginning value, minus transaction cost. So we're still doing the minus transaction cost adjusted for taxes. We're just adjusting them for the tax. Cap gains minus cap gains tax. Capital gains. So this is still kind of your end value minus beginning value, in a way, right? Okay, I don't know. Maybe you need to do the HPR first, define the HPR, and then figure it out. Let's just see. This equation can be used only for historical calculations, because the actual tax liability amount must be determined before actually calculating the return. However, to estimate the after-tax rate of return for projection purposes, where taxation occurs annually, a financial planner can also use the following calculation, which looks way better. Use this one. Okay, RT equals R times 1 minus T, where RT equals tax adjusted return, R equals nominal return, T equals investors' marginal tax bracket. Oh, this song is unfathomably good. Okay, investors' marginal tax bracket. I don't know what that means. Okay, but let's look at the example and we'll be okay. Holy, this song is beautiful. Oh my gosh. Holy smokes, I'm crying. Alright, expanding on the previous example, assume Bob owned the stock in a non-tax qualifying account. Bob owned the stock, back to here, in a non-tax qualifying account. I don't know what a tax qualified account is. And dividends and capital gains are taxed at a short-term rate of 15%. His after-tax rate of return would be 13.26% as shown below. Okay, so they solved it for us here, but let's go back in and let's try and solve it. So using previous example, Bob was talking a non-tax qualified account. The dividends and capital gains. Dividends and capital gains are taxed at a short-term tax rate of 15%. Okay. His after-tax rate of return. Okay, so okay. So tax-adjusted return. That's what we're solving for. So RT equals nominal return, which is 15.6, allegedly it is, times 1 minus the investor's marginal tax bracket. So that's that 15%. So we can also just do this as 0.156 to simplify our symbols here. And that gets you 13.26%. So, R, that nominal return, is the same thing as the Yo, Annika's here. That's pretty sick. The nominal return is the same as your HPR. That's so funny. She really did just say hi and then she left. Okay, sick. So that's the same as your HPR, and you're multiplying your time by 1 minus T. So your investor's marginal tax bracket is also equivalent to what was that in the problem it just told me? His after-tax rate of return would be 13.26. So this is also your after-tax rate of return. That's funny. After-tax rate of return. Hang on. What are you talking about? What are you saying? Wait, this is fun. Nominal to return. What the heck? Okay. Chill. That's chill. Sorry, I have my phone open with the chat because my screen, this little window on my screen is the whole screen. So I can't see the chat, which is probably for the better because I get distracted super easily. Okay. We've finished B. We're moving into C, which you probably can't even see now that I'm realizing it. Yeah, that's so tiny. Let's see if I can make this bigger for you. Is that better? Oh, it just makes my page smaller. Okay, fire. So, moving into C, the dollar-weighted return. Dollar-weighted return. I don't know what this means. Okay, the problem with using a holding period return, your HPR, is that the formula does not account for the timing of subsequent cash flows into or out of account. Okay, so this solves the problem. This solves the problem because HPR does not account for subsequent cash flows. So you need a new formula to factor in any cash coming in or out of the account, in addition to how the tax is going to influence that. So a fundamental formula that corrects for the timing of subsequent cash flows is the dollar-weighted return formula. On the next page, I can't wait. Okay, that's the formula. That's so funny. Yeah, okay, you're welcome. I'm glad you can see. Low key, let me pull up my OBS. I can probably make it's not so important that you see me. So I can make this a little bit bigger for you. Is that better? I mean, shoot. It's hard with a widescreen monitor because or I could hop down here. Nah, I need to be, okay. Whatever the case, let's hop back in. We have a formula to study. Okay. Income plus end, I assume they're talking about end value minus your beginning value. Okay, looking familiar so far, plus D, that's a new term. We're gonna have to find the definition of that. Minus W, DW, Arthur, minus costs. Those dang costs. Okay, and all of that is in brackets here. What the heck is going on? This is all in its own big old bracket. And you're dividing by, holy, this is going to be impossible to remember. dt, we're applying a time value to these values. Okay. We're just going to keep that there. We're going to simplify this to a DWR, dollar weighted return. And we're just going to refer to the actual page for our values here. So income, obviously, end value, beginning value, deposit amount, withdraw amount. D is deposit amount. W equals withdraw amount. Okay, this makes perfect sense because the whole purpose of this calculation was factoring in those inflows and outflows. Costs is transaction costs. Fire. Okay. These are all in brackets. Okay, so then you have your beginning value again. dt, d times 1 minus the time you have deposit. It's gonna be tough. Okay, let's just do this. dt equals d times 1 minus time of deposit. Holy smokes, I cannot type. All right. Example time. Altering the preceding example. Assume that 1 year after Bob made his initial 1 share purchase. Okay, so Bob made the purchase of this stock up here. He made it for $45, sold it for $55. But we're altering it, so he probably didn't sell anymore. After he made his initial purchase, he bought an additional 2 shares of stock at $48. Okay. So Bob bought 1 share for $45. Beautiful. Let's make sure we're being clear here. Example time. Bob bought 1 share for $45. 1 year later, Bob bought 2 more shares let's do an at symbol, at $48 per share, or $96. Helpful. Further, assume he sold 1 share at $45 at the end of the second. Okay. We're getting complicated now. Assume that he sold 1 share at $45 at the end of the second year and liquidated the account after 3 years. Holy cow, I'm freaking out. So, with this kind of problem, every finance teacher you're going to have is going to recommend you draw out a timeline. If I do that, you're not going to be able to see it. I don't have a top-down camera, nor a pencil, nor a piece of paper handy. So let's just look at it and see if we can't talk through what's going on here. Okay, so he sold 1 share at $45 at the end of the second year. At the end of the second year. So he bought a share for $45. A year goes by. He buys 2 more at $48. A year goes by. He sells 1 for $45. And then after 3 years, the end of the third year, he liquidates the account. So he sells the last 2 at $50 per share. So he sold at $45 and he sold 2 at $50. Great. And so we're looking for, this is actually very handy. This will come up a lot. He still receives semi-annual dividends of $1 per share, $12 total. Semi-annual. Is that 2 per year or 1 every 2 years? Biannual, semi-annual. Okay, so $2 per year per share. 3 shares. 3 years. 3 times. Okay. It's telling us it's $12. So we received $12 in dividends. That's incredible. So this $12 in the dollar-weighted HPR. Can y'all hear this music? It is. Oh my. Okay, $12 plus 100. Why is this 100? End value. Okay, we're back to this. Can I highlight this? How do I make this color that I like? How do I make it turn? Ooh. Green. Okay, this is the formula we're looking at right now. So your income. Income is how much he makes from those dividends, from all of the shares the whole time. That's $12. Plus, now we're hopping into these brackets. The end value, after he liquidated, he was left with $100. Because he liquidated the account for 3 years at $50 per share, leaving him with $100. The end value. So, holy cow, this music is intense. Let's skip. That's the end value. You're not factoring in the 45 that he sold after the second year because that happened in the process. So we're only looking at the end value here. So then you subtract the beginning value. At the very start, he bought a share for $45. So that's where that 45 comes from. Plus the deposit amount. Okay. What does that mean? What does that mean? The deposit amount. So it's telling us 96, which means that the deposit amount is the additional 2 shares of stock that he bought at $48 per share. Is that a deposit or is that a purchase? I'm a little confused. Let's continue on and see if this doesn't become clear. Minus the withdraw amount. Okay, so it's as if it's money that goes in and money that goes out. So you're depositing 96 into the account and you're taking 45 out because at the end of that second year, you sold 45. So that's ins and outs. Let's just look at D as in, W as out. 45 or 96 in, 45 out. I like it. Now, what were our costs? Hold on. 45. Okay, so in this formula we have beginning value. Okay, hang on. Income, 12. End value, 100. Beginning value plus D minus W. Beginning value, 45 plus D minus W. Okay, we're in business. We're still good. Minus costs. Costs of $5. Total transaction cost was still $5. Awesome. What was Bob's dollar-weighted rate of return? Okay, so that's our top line. Our bottom line then, beginning value. What is going on? Where do these fractions come from? Let's not freak out. Let's approach it bravely. Okay, $45 is still our beginning value. We're good there. Then we're hopping into our deposits. Okay. This is easy. Guys. This is not even hard. Deposit. Okay, what is it called? Timing of the, whatever that, I don't know what it actually means. So D, the deposit at the time of the deposit. Something like that, deposit amount. So 96 goes back to that inflow. That's what we're putting into the account. $96, 48 per share times 2. $96 times 1, just like our formula here, minus timing of deposit. What the freak? Alright, now I'm lost. Why on earth are we dividing by 36? Why on earth? How many months are in a year? Not 36, I'll tell you that much. Okay, I've got a great idea. It's because we're doing it by months compared to the number of years. 12 months in a year, and the account was liquidated at the 3rd year. And so at the end of the 1st year, perfect, this makes sense now. Okay, so you're using months, because at the end of the 1st year is when he deposited. After a year had passed, he deposited the 96. So you do 1 minus 12 over 36. So you have 1 minus a third. And then you subtract 45, which is our withdrawal we're taking out. And what time did that happen? After the 2nd year. So 24 over 36. Now, I don't know why they do months instead of saying 1 over 3, 2 over 3. It would be the exact same outcome, and holy smokes, that's loud. Bump it down a little bit. Okay. But okay, we've worked it through, we've rationalized it, and figured it out. So, I'm going to allow them to do the calculations there, but just know it's 96 times 1 minus a third, minus 45 times 1 minus 2/3. More setting for music, setting up for a breakthrough. Yeah, that was crazy. Okay. So this is our dollar-weighted HPR. Now that we've talked it through, we haven't worked it through on paper per se, but we know what it all means now. We could look at the dollar-weighted HPR and understand its purpose, how to solve for it, why it exists. Because the regular HPR and the tax-adjusted HPR can only look at a point in time without understanding fully comprehensively if they made any withdrawals or deposits. So it's a very limiting formula. But the dollar-weighted return is what we're looking for here. Solves a lot of problems. So now we're moving into time-weighted return. Don't you have work, Annika? What day is it? Tuesday at 11 a.m. What in tarnation? How the heck do I have 5 viewers? That makes no sense to me. Okay, so we're moving into time-weighted return. An alternative to dollar-weighted returns. Okay, so we just did dollar-weighted returns, which accounts for the inflows and outflows, the withdrawals and deposits. But an alternative to dollar-weighted returns is a time-weighted return. This calculation method ignores the actual value of the investments during each time period. Interesting. That gives me pause. Why would it ignore the actual value of the investment during the time period? Let's look back at the example. We're back to Bob. Example, back to Bob. Okay, back to Bob's situation. It's known that the stock was initially purchased for 45 per share and was valued as follows. We're about to turn the page, but just remember, he bought the stock at 45 per share. This has been consistent through all of our other examples. Okay. Let's go to the next page. End of the year 1, 48. End of year 2, 45. End of year 3, 50. What? Valued as follows. Okay, so this is the valuation of the stock that he bought. That first stock. That's the share price going up and down through the years. Using the holding period return, HPR formula results in the following annual rate of return. We already did the HPR. HPR was back to this one. Income plus end value minus beginning value. And there was, where the heck is transaction cost? Over beginning value. I guess there was no transaction cost in this example. And then you're averaging them out. Ooh. Wait, that's very interesting. Using the holding period return formula results in the following annual rates of return. My question is, why is there no transaction cost? Because we didn't sell the share yet. We were holding it throughout the 3 years. Why would there be a transaction cost when you haven't sold? Perfect. So the time-weighted return, you're taking HPR for each year. Take the HPR for each year, then average the return for the years, over the years. That was a weird spike we received a little bit ago, where I got 5 viewers, and that makes no sense to me how that even happens. But we're having fun. How much time do I have left? 15 minutes. Okay, I have to go catch a movie in 15 minutes, or a little more than that. We'll keep going. Thus, the average of the 3 annual returns results in a time-weighted return of 8.2. HPR, 11.1. HPR 2, negative 2.1. So this is simple. You receive the dividends, semi-annual dividends, so that's your income of $2. at the beginning of the year, end of the year minus beginning, boom. End of the year, because the end of year 2 is 45, 45 minus 48, because that's the start of year 2, the beginning price, and then the start of year 3, your beginning went back to 45. So it's here, 48 to 48, 45 to 45, boom. Just take a minute and appreciate that music. Oh my. This is beautiful. Okay. Thus, the average, okay. Dividend is same, perfect. Which measure is the best? It depends on asset control characteristics. So these are 3 different ways to arrive at the similar end goal. But it depends on asset control characteristics. Investors who control their own investments, both the timing and amount of purchase, will want to use the dollar-weighted average. Dollar-weighted average. That's what we found up here. Investors, okay, let's figure out what that actually means. Investors who control their own investments. Investors who control their own investments prefer dollar-weighted average. In this case, the more money invested when a stock is performing well, the more money the investor will have in the end. However, someone who does not control the timing and amount of the investment, such as a portfolio manager does not control the timing and amount of investment. What would they prefer? What do y'all think? Ooh, we're getting some pans here. Who want to assess? We're going to assess performance using the time-weighted measure. Time-weighted measure. It would be inappropriate to examine a portfolio manager's success or failure based on inputs over which the manager does not have complete control. That's pretty interesting. And that's about all I have to say about that. I don't really understand that completely, but I like it, and I think it's cool. Help. Help. Oh my gosh. What is going on? Give me my point back. Okay. Boom. Okay, average annual returns. On to another topic. Average annual returns are some of the most quoted statistics in finance. These returns are easy to calculate, relatively simple to interpret, and for the most part, intuitive. I like that. I like intuitive. However, the most common usage for these statistics is to incorporate them into models to predict future investment results. Okay, let's note that down. Most common use, incorporate into models to predict future investment results. Okay. It's important to remember that the most historic return calculations tend to have a bias or partial perspective when used to project future terminal values. A downward bias means that the average used to project the future value tends to underestimate and upward tends to overestimate. That makes sense. Biases occur because an investor's cumulative return is a nonlinear function of average return. Investors' cumulative return is a nonlinear function of average return. What does that even mean? The following discussion of arithmetic and geometry averages presents the calculation of two systems. Okay, this is easy. Average annual return. Okay, sure. Arithmetic, and geometric means. I remember this at my old college, Temple University. Calculation and deterministic forecasting. Okay, so arithmetic mean, we don't even need to go over this. This is simple stuff. You take all the things over how many periods there are. We're just going to skim right through this. Standard deviation. Oh, this makes me cringe. There was a period of time where I had to do so much standard deviation in school, and it made me sad. Okay. Um, Standard deviation is the average difference between the individual outcome and the average or expected outcome. So, okay, more in depth later in the chapter. Fire. Okay, let's look at this example. Consider a $100 stock that rises 50% in 1 year and falls 50% in the next. So it rises 50% here, 150, and falls 50% in the next. That puts you at 75. The arithmetic mean return is 0. However, when the return is tracked, it's apparent that the final price was 150 in the first year, then the 50% drops final to 75. Okay, perfect. The total return is obviously less than 0, a negative 25% total return. What? Then the 50% drop results in a final value of 75. The total return is obviously less than 0. Oh, I get it now. Okay, the total return is obviously less than 0, a negative 25% total return because you went from the 100 to the 75, up 50, down 50. It also has a negative 13.4% geometric return. That's different. I don't think we went over that. Okay, CAGR, that's a big keyword that we're going to have to go through. As this example illustrates, the geometric mean is recommended for forecasting future values. The geometric mean is often referred to as a geo-mean. I've not heard that term. Let's note it down. Geo-mean. Geometric return. The annualized return, or the compounding annual growth rate. Let's just put CAGR, because I know what that means. The formula for calculating a geometric average is as follows. So you have 1 plus the return in year 1 times 1 plus the return in year 2, etc., etc., etc. To the 1 over n power minus 1. Let's look at the example. I'm sure this will all clear itself up very shortly. Okay, Tanya purchased an investment 7 years ago. Okay, so we're ditching Bob. We're on to Tanya. Tanya example. She purchased an investment 7 years ago. Purchase 7 years ago. 7 years ago. Okay. According to the investment's annual report, the investment earned the rates of return shown in figure 2.1 on the next page. She wants to know what return she could project for the next 7 years by calculating the annual return. So she's trying to project 7 years out what return. Okay, so let's look at the table here. Okay. These are all over the place. So in year 1, expected rate of return is 9%, then negative 8, then 2, then 12, then 18, and so on and so on. And so, it's basically just spelling it out for us clearly here. The geo-mean, or the CAGR, the compounded annual growth rate. So you're taking all of these. This is there are simpler ways to do this, I know. I'm sure we'll get to them later. But, so you take 1 plus this rate of return times 1. Okay, so you're basically just adding them all, or multiplying them all up for every single year. Then at the last year, you go 1 over how many years it's been, raised to the 1 over 7, and then subtract 1. That gives you 3.9%, compared to the simple linear average of the arithmetic mean, which is 4.29. So the arithmetic mean overestimates the return, and the geometric mean underestimates, per se, biased downwards versus biased upwards. For example, 7 years ago, a client might have asked for a future value of $500,000 in 7 years. Sure. However, the account only grew up to 6. Okay, overstatement of the actual account true. It's not insignificant. What if the client had $2 million asked for a 25-year projection? In this case, yeah, it'd be huge. Totally. So using a geometric average. Okay. So ultimately our takeaway. Use geo-mean over arithmetic mean, because it is better to understate than overstate in financial planning, because it makes a huge difference in the long run. I don't know why it never works to okay. Fire. Okay, downward versus upward bias. That's what downward bias. That's the key word that the book is using here. Okay, but this too is not without its flaws. A future value calculated using a geometric average is likely to have a slight downward bias. Exactly like I said. Guys, I think I'm learning. This means that the entire future value achieved is prone to be slightly greater than the future value projected. When forecasting periods are much shorter than the sample period from which the averages were calculated. What? The true average tends to be closer to the... Oh my. So it's not a clear case for every example. For forecasting periods that are much closer in length to the sample period, the true average will be closer to the geometric means. Okay. For forecasting periods, so say you're forecasting for 7 years, that are much closer in length to the sample period. What does that mean? Sure. Okay, so if your sample period, historically you had 7 years, and you're forecasting for 7 years, the true average will be closer. But, say if you're forecasting for 3 years, and your sample period is 10 or 7, the true average is closer. Interesting. Very interesting. Okay. I'm just gonna remember that. Arithmetic geometric returns compared. Lovely. Let's just skim this. If the return is fixed, that means, okay, it'll be equal if the return is fixed. So if your annual return was 3% every single year, you just use the simpler one. Standard deviation of the return. Wait. It is worth noting that as the standard deviation of the return approaches 0, the difference between the arithmetic mean and the geometric mean also approaches 0. Are equal to terms fixed. Okay, perfect, makes sense. The opposite is true. As the standard deviation of the outcome increases, the difference also increases. I like that point, easy to remember. As the standard deviation, well, I remember that, yeah, increases, the difference between the arithmetic and geometric mean also increases. Yeah. Cool. Good to know. Variance, arithmetic average, variance. Is that the same? What's okay? Variance. I mean, hey, whatever. Sure. I like it. We're moving through. Okay, example time. Great. These help me a lot in understanding. A client has an account balance of $50,000. The client assumes that since the average annual return of the stock market has been 10% over the last 20 years, the next 20 years should result in the same return. Even if history were to repeat itself, the client should not use the 10% average annual return, but the 8.2% geometric average return instead. By using the incorrect average return to project the value of the account in 20 years, the client will likely overstate the account balance by nearly $95,000. Using the 10% return results in an account balance of $336,000. Wow, versus $241,000. So, like we were talking about before, they're using the last 10 years, or using the last 20 to project the next 20. And so, the following rules, when forecasting periods that are much closer in length to the sample period, the true average... Alright, what the heck, man? That just ruined everything. I guess the point of this is just to say it's better to understate in this example because over the long period of time, it makes a huge difference. One of the most significant issues associated with calculating geometric averages is that individual periodic returns are needed to construct the geometric series. This song is good. Okay. Whoa, we're getting a cool formula. The following formula can be used to back into the geomean if a return series is unavailable. Whoa! If you want the geomean, but can only get the arithmetic mean, use this formula. Okay. Geomean, I don't need to do all caps for that. Geomean equals arithmetic mean minus 1/2 variance of the variance of the variance of the variance. Okay. Example, using the preceding example, where the arithmetic average was 10.10% and the variance was 3.89, 10.10 minus 1/2 times 3.89. Guys, that's easy. That's easy, and we're golden. How much time do I have? Frick. That was the end. 11. Yeah, low key. Okay, let's do one more chapter. Let's do one more chapter. Or one more. Let's just see what they have to say. How much? Okay, let's also check the how long is chapter 2? Oh my gosh. Oh, this is fine. After we get through, good grief. Oh my gosh. 2.7 has n parts. That's like over half the alphabet. A, B, C, D, E, F, G, H, I, J, L, M, N. That's literally over half the alphabet. Okay, so let's get through 2.6, and then we'll save 2.7 and the rest. Oh, we're so golden, guys. We're cooking. We're actually cooking. This is fun. Talking through this actually helps me a lot. Okay, so let's do 2.5 and 2.6. Weighted portfolio returns. Weighted portfolio returns. Multi-asset. Sometimes it's necessary to calculate a weighted average return for different assets or values. A weighted average is calculated by multiplying the return generated by an investment. Multiply the return generated by an investment, sure, by the proportion of the portfolio held in the investment. Some bells should be ringing, y'all. We've done this before in previous classes. And then summing the total for all the investments. For example, figure 2.3, okay. Okay. Totally, we've done this all before. This is golden. Okay. So we have all these different funds that have a total value. And now this is the percentage of the value they have, summing to 100. ROR, rate of return. This is the rate of return that each piece, think of it like one big pie. Each fund has a different rate of return. So you're going to multiply the percentage times the rate of return to get the weighted return. That is worth noting. That's very important. In fact, what I'm going to do is I'm just going to go ahead and copy this. Just hop it right into my... right into the Notion because I want to take that exact picture. How do I insert? Anybody know, y'all? How the heck do I add something? Add an image. Help me add an image. Add an image. I gasped. Downloads. Screenshot. Beautiful. We're locked in. So this is a very helpful graph, just to remember, because it's tough to type all that out. Okay. Nearly all financial planning forecasts are based on the notion, oh my, y'all, that the future will closely resemble the past. If you took forecasting, that should be familiar. I did. This is obviously a tenuous assumption. Deterministic modeling based on historical averages can sometimes be misrepresentative of the near-term future. Sure. Whoa, using the same methodology, probability of occurrence. Whoa, that is interesting. You can assign probability too. You can also, so since the past does not always provide the best indication of the future, you can assign probability. Assign probability to to what? Assign probability to the return as well. Exclamation mark. So then you do probability of occurrence, A, times corresponding return, B, equals weighted return. So, okay, so this is more scenario-based. Rather than talking about the funds themselves within that pie, you're taking the potential economic outcome. Okay, that makes sense. So the probability that you have normal growth, stagnation, recession, depression, these are the probabilities. Corresponding return, if those were to happen, then the weighted return. I don't fully get that, but I get it enough to move on. Occurrence has 2 R's? It does, wow. Okay, types and forms of interest rates. Types and forms of interest rates. 2.6. Let's label these. I think I should have been labeling these all along. All along, I was looking for something more. Okay. Real and nominal rates. Real versus nominal. Nearly all interest rates quoted online in magazines and annual reports are nominal rates. Basically, everything is nominal. Can we say that? Meaning that the rate has not been adjusted. Meaning, helpful. Means the rate has not been adjusted for inflation. We actually have noted that previously in our notes. Nominal rates are used when the actual dollar amount of an investment is important. By contrast, the real rate of return is the return left over. The real rate is the return left over after adjusting for inflation. That's important, very important in fact. This return provides a more accurate representation of purchasing power. Provides a more accurate representation of purchasing power. Because if you think about it, if you have say you made, well, it's not quite the same thing. What was I even about to say? It's a similar concept to like, okay, you make this much income, but what's your actual, what am I saying? Like you make this much in sales, but what's your actual income? What can you actually do with it? If we're just using the nominal, you're not adjusting for inflation. That's money that you don't actually have, or that you won't actually have in the future if you're projecting. So you need to factor that in. Okay, which is an important consideration for long-term investments, right? A client may be interested in having a portfolio value of $1 million when they turn 65, but if they do not recognize the purchasing value, that's what. Okay, right. Exactly. You guys get what I'm saying. 2 equations account for the effects of inflation. One, if the nominal rate of return is continuously compounded, and another if the nominal rate is discretely or not continuously compounded. Okay. 2 formulas. 2 formulas. The difference is the nominal interest compounded continuously, or is it discretely, or is it not is it not continuously compounded, aka discretely compounded? I don't know what that even means, bro. I have literally no idea what that means. Do you? I don't even know who this mysterious second. It's probably still Annika, bro. Okay, suppose the nominal rate of return is continuously compounded. I like that. In that case, it is appropriate to subtract the inflation rate from the nominal rate to determine an approximation of the real rate as follows. Okay, continuously. Sure. R equals R minus I. Well, that could be more simple. R equals real rate. R equals nominal rate, big R I should say. I equals inflation rate. You guessed it. Example. I love examples. The nominal annual rate of return on Mary's portfolio is 9%. Nominal rate, 9%. So big R is 9. So R equals 9% minus the annual inflation rate is 4%. Easy. So you are left with R equals little r. The real rate is 5%. Delightful, simple, easy as pie. However, suppose the nominal rate is not continuously. In that case, a different equation, often referred to as, is it not, well, let's say, if not continuously compounded, Fisher, my arrow. Fisher equation. That needs a better name. Who, like Bobby Fischer, the chess connoisseur? The result of this calculation is referred to as a serial interest rate. The results of Fisher is the serial interest rate. Sure, works for me. The formula is as follows. Oh, I've seen this. This has a better name. This has something else, but I've seen this formula before. R equals 1 plus the nominal rate over, I use this a lot in one of my classes, plus interest, and you subtract 1 from it. Yeah, okay. Example. The nominal annual rate of return on Mary's portfolio is 9%. The annual rate of inflation is 4%. In this case, the nominal rate of return is not continuously compounded. The real rate of return is no longer than 5%, but slightly less than 5%. Okay, 4.81. That was just describing the answer. But what exactly does it mean for something to be not continuously compounded? I guess it means if it's compounded at the end, or on a year-by-year basis. I'm not entirely sure. This calculation should be used whenever a client faces inflation risk when making an investment. Should be used when client faces inflation risk when making an investment, which I think is ultimately all the time. This is a fundamental formula when determining the present value of an inflation-adjusted dollar amount. As is the case anytime a financial planner or investor calculates future values but states the results in today's dollars. Used anytime you need to calculate future values stated with results in today's dollars. Inflation adjusted amount. Okay, that's very, very important. Yeah, makes sense. Cool. B, tax exempt and taxable rates. I'm getting hungry. Tax exempt. 11:30. Frick! I gotta go soon, man. I got my movie. I'm seeing Project Hail Mary in 30 minutes. I'm so excited. I couldn't be more excited. Can we get, like, some engagement in the chat for that, or? What on earth just happened outside mine? Okay. I also need a haircut. In addition to the difference between nominal rates and the rates of return, financial planners need to account for differences between taxable and tax-exempt rates of return. Very interesting. The concept of tax impact was briefly introduced earlier. For the most part, exact after-tax returns cannot be determined until the end of an investment period. However, apply a client's marginal tax bracket. Okay, so it's hard to determine exact after-tax, holy moly, I can't type, after-tax returns until the end of an investing period. Naturally, that just makes sense because you don't know. However, you can apply a client's marginal tax bracket to a return calculation to reasonably estimate it. That's important. You just want to get close here with these after-tax returns. So, for our example, a client is in the 25% marginal tax bracket, and the expected return on an investment is 7%. By applying the following formula, a financial planner can determine how much of the return will benefit the client. Okay, let's look at the following formula. What on earth is, what's that little thing? Okay, let's copy down this formula because we're going to need it in the future. We have that. What is R was the real rate equals, or in this case, the after-tax rate equals the nominal rate times 1 minus the federal marginal tax rate. Now, isn't that awfully similar? It is different. It is a little bit different. Yeah, I know. I'm so excited. Ryan Gosling. I literally can't wait. Literally, in 30 minutes, I will be in the theater and I will be watching Project Hail Mary. And then I gotta figure out how to condense all of these things because I could be streaming on a different channel, or I repurpose that my like Brian Soderbergh channel. I can convert that to this channel, post those videos up on here, and then I'll be able to live stream on this channel because I would be doing it on that channel as like my personal second thing. Having 3 channels, I feel like is just stupid. Anyway, I also want to play Minecraft. Besides the point, I got so much work to do. I can't play Minecraft. Okay. So, we're doing tax rate stuff. Okay, for sure. So, 7%, 1 minus the 25%, 500%. Okay, so you have, let's go back to it. The expected return of the investment was 7%. Expected return was 7%, and marginal tax bracket was 25%. So then in this formula, you have our little guy equals 0.07 times 1 minus 0.25, which gives you 5, oh my days, equals 5.25%. Okay, that's their after-tax return. After-tax return. If the client invested $1,000 in a taxable account and the account returns 7% per year, or $70, then the client will keep 52.5 of those dollars. Very interesting. This makes a lot of sense. This makes a lot of sense. The investor will pay $1,750 in taxes. So you would have made, so before taxes 70. Okay, that's very helpful. This is a very helpful formula. Now, how does this work compared to this one? So this is inflation, and then this is taxes. Do you use both? This formula can be expanded to include the impact of state taxes. In many states, state income taxes are levied against gains that are managed. The state tax rate cannot simply be added to the federal tax rate in the preceding formula. The client's federal tax bracket essentially reduces the state tax rate. This adjustment is accomplished using the same formula as above, except the state tax replaces the nominal rate in the formula. Now the combined after-tax rate can be determined combining both of the preceding equations as follows. What the freak? Taxable equivalent yield. So is this saying this is federal and state in one? Is that what that's saying? Nominal rate times, yeah. Okay, so this is federal and state. That's pretty interesting. Gosh. I'm just gonna note, there is a formula for combined federal and state tax returns. Are we almost done with this chapter? Okay, good, we're almost done. The following formula can be used to determine the TEY is what? TEY, important term, TEY equals taxable equivalent yield. I'm so, sorry, wow, I was getting fired up. That song had me like about to explode with excitement and joy. Alright. We've got to finish this. Actually, we don't. I gotta go. Alright, y'all. That's gonna be the end of this stream. I hope you enjoyed. I gotta go catch a movie. This has been a blast. Farewell. I guess it's literally just been my sister here, but that's chill.